Yoshikami is Chief Investment Strategist for YCMNet Advisors. He oversees about $1 billion in assets. He joins us from Los Angeles. Michael, I mean, what do you make of this downward trend today? Is it something more significant starting to build here in the equity trade?
No, I really don't think there is something more significant. I think it really is just a reaction to a massive run-up we've had over the last couple of weeks. Plus, I think the fact that hostilities are extending in Libya. It's not quite the slam dunk that everybody thought it would be, maybe just over a few days. I think that is definitely putting pressure on oil prices, and oil prices are really the key here. I think it all is about economic headwinds with what's happening in the Mideast. So I think that's what investors are looking at right now. I don't think this is really something to be terribly alarmed at this point. I still think that the economy can still move forward at $100 oil prices. 120 is a whole other story, but at $100 oil prices, I think the economy can still move forward.
Hey, Jeff Kilburg, you're out there in Chicago. You're Senior Development Director at Treasury Curve. You trade Treasury stock and Euro futures. I'm just curious, do you agree with Michael that what we're seeing today is just kind of a reaction to the massive run-up that we've had in the equity trade?
Hey, Carol, great to be here. Don't necessarily agree there. You know, we've actually seen a big down move here in these equities today. I think that's a reaction to oil. Clearly, we have a lot of headwinds in the market today, but the focus, the paramount issue at hand is oil. And as that oil gets its legs above $100, we're going to see how it reacts. But the bond market, for the first time, is seeing some sustainable fear drive. We're seeing a flight to quality like we did last week.
Hey, you know, you're not the only one watching oil. Michael pointed it out. So did Fed Chairman Ben Bernanke. Everybody, listen up to this, what Ben Bernanke had to say up on Capitol Hill today about the impact of rising oil prices.
My sense is that the increases that we've seen so far, well, obviously a problem for a lot of people, do not yet pose a significant risk either to the recovery or to the maintenance of overall stable inflation. However, we'll just have to continue to watch. If we see any significant additional increases, we'll obviously have to take that very seriously.
So, Michael, let me go back to the point you made. So you're comfortable here, but if we get to something like $120 a barrel oil, then we have to start being worried.
Yeah, I think anytime you get above sustainable 110, I think it becomes a problem for the economy, and I think you start to chip away at GDP growth. Remember what's happening right now in the economy is the Fed, as well as the Treasury, has thrown massive amounts of money through deficits as well as quantitative easing. Some of that is going to be unwound with higher oil prices. So I think it is something to watch. It's anybody's guess where oil is going to go from here. If it goes to 120, it's going to be problematic. If it stabilizes at $100 or even drops down to 90, then I think we're off to the races again.
Hey, Michael, it's Julie. Of course, it's not only oil prices that have been heading higher. It's pretty much everything within the commodities basket. So, you know, if 100 or 120 is your threshold for oil, I mean, do you have to watch thresholds for copper or for grains or for pretty much all the prices that have been rising?
Well, I'll tell you, I think that what you really actually have to do is you have to buy commodities. I don't think you want to invest just in equities on the hope that commodity prices will slow down or oil prices will slow down. I think the bottom line is that inflation is going to trickle through the system. We have emerging market growth that's going to continue to emerge. And when that happens, and as that happens, I think commodity prices are going to continue to fly higher. We're big believers in having all types of commodity. Even gold at this price, I think, can go higher. And I'm talking about basic commodities even besides energy. Things like food products, cotton, sugar. These types of assets, I think, need to be in investors' portfolios, Michael, as a hedge against inflation.
What's the best way to play it? Do you look at the ETFs? Do you buy the futures? What way are you getting into these commodities?
I think for most investors, the best way to do it is to buy ETFs. I mean, there are plenty of diversified ETFs out there you can get in. They have tremendous liquidity. Certainly, you mentioned earlier, or was mentioned earlier, that gold is certainly a commodity that people can get into very easily. I think that's the easiest way for investors without having to navigate what can sometimes be a fairly perilous path investing in the futures markets.
Hey, Adam, you know, we were just talking a bunch about commodities, energy specifically. You've been following the fuel factor and really its effect on transports. What about airlines? When I think of transports, I also think of the airline sector.
Oh, yeah. Well, I tell you, I got a chart for Michael Yoshikami. Michael, wait till you see this one, all right? It's effectively, over the past 2 weeks, the price of oil versus the airline stocks. And, of course, oil up 15%, the airline stocks down over 8%. Earlier today, you had UBS lower its target on AMR, American Airlines parent, from $9 to $7. The stock's at $6.56, I think, was the close. So basically dead money. And I guess, Michael, the question is this so real that, frankly, you don't even want to go near stocks like airlines at this point?
I don't think you do. I think that the kind of stocks and the stocks we've been migrating to are positions that are more defensive names. You mentioned some of them in terms of healthcare stocks, which are much maligned, but frankly pay high dividend rates and are pretty defensive positions now that healthcare reform seems to be settling down. Some of the consumer names, I think those are the kind of names you need to head to. I think you don't want to be speculating in stocks that are going to be impacted by higher energy prices. If you're going to do that, just buy energy.
Hey, guys, I want to throw something else at you because there's some headlines crossing. This is coming from the Treasury Department. The government apparently will reach its $14.29 trillion legal debt limit between April 15th and May 31st if Congress does not act. This is kind of an earlier thing. I think in February, the department projected the limit might be reached between April 5th and May 31st. So they're moving up this date. Peter Cook, our chief White House or Washington correspondent, he's saying, you know, markets care about this. This means that the debt ceiling vote needs to happen before that. Jeff, do you care about this? I mean, how closely are you watching things like this in terms of the debt ceiling and the debt limits?
Well, clearly we are market sensitive to that, and I think that extension is coming. But just to get back to, you know, the overall policy here, look at Ben Bernanke today. He kind of straddled the fence, and a lot of the issues here at hand, he just wants to see how those develop the next couple months. So I think the Fed is trying to sit there with one foot on the brake and one foot on the gas, because we've had a lot of conversation 2 weeks ago of the QE2 possibly being curtailed. But with these possible headwinds and the escalation of the Middle East, I think they want to sit back and just watch how this develops out. But I don't think that right now Ben Bernanke is ready to make any decision.
Hey, Michael, when you sit back, do you think when all is said and done, anything is going to be done about the debt problems, the deficit problems, that we're going to get rein-in spending on a fiscal level, or are we just going to see a lot of political talk at this point?
It's hard to believe we're not going to just see political talk at this point. I think that the debt ceiling is going to be just posturing. I think that'll get resolved. What I'm more concerned about, Carol, is what's going to happen over the next year, over the next 2 years when all the stimulus runs out. I personally think quantitative easing, regardless of what's said by the Fed, they're going to run that all the way through until its end. Once that runs out and the economy has to start running on its own with higher energy prices and higher deficits, where is the political will going to be to cut deficits? I would like to believe it's going to happen. I tend to be fairly pessimistic that there's going to be hard choices made.
You know, it's interesting that you bring this up because I think about all of the news flow today, and, you know, we helped out the automakers and they seem to be back on track. Just to kind of give everybody some assessment, you know, Don, we did get those auto numbers today. Just remind us where they came in.
Talk about what happened without government stimulus. Remember, when Cash for Clunkers, the government program, got withdrawn, we thought auto sales might not recover. Check out what's going on here. GM comes out with sales plus 46%, better than estimates. Toyota, better than estimates. Ford, better than estimates. So this is an indication, Carol, guys, of what happens when the government steps away. So I guess the question to, Michael Yoshikami is that a real issue? We have seen the economy stand on its own two legs without government stimulus. The autos are a classic example, aren't they?
Well, yeah, but let's face it, the autos got a pretty sweet deal, right? They were allowed to declare bankruptcy. General Motors could declare bankruptcy, get rid of their bondholders, essentially, and have a fresh start. You know, the government can only do that for so many industries. I mean, they certainly have done it with AIG and the financial service industry. The question is, what about the entire economy? The government can only borrow and essentially loan and prop up so many businesses. So I think there are selected businesses that's done very well. I think that's the real secret of TARP that no one really realizes.
Right.
It hasn't been a disastrous program.
Hey.
But I think there's going to be a limit on how much they can do to really prop up the economy.
Guys, just got a few seconds left here. Jeff, I want to give you some time here because I'm looking ahead to that Friday jobs report. You guys starting to talk about this and what we might get and how that might impact the trade?
Absolutely, Carol. You know, obviously we're going to look at the ADP tomorrow, which is kind of a wild card. We've seen that number hit and miss. But that Friday unemployment number we're really looking to. And there's a little red flag right now in the Treasury market, especially in the 30-year. You know, we actually tested a technical level, the weekly pivot at 119.26 today. We stayed above that. So as those prices continue to go higher, those yields will come down.
All right, guys, got to run. Thanks so much for walking us through the close. We've got Michael Yoshikami and also Jeff Kilburg. Guys, thank you so much.